Last weekend, we had a ton of news. We had the OPEC meeting, we had the Iranian headlines coming out, we had Ukraine launching huge attacks deep into Russia. And this week, we priced all that stuff in. Did the market do it right? What's the market trying to tell us? Let's get into it this week in oil. Hey, I'm Aaron Kildow with 30 years of experience in oil trading and analytics, and I'm here to elevate your understanding of the oil market. So let's get into it. All right, here we go, guys. Let's get into the presentation for this week. Remember, if you go to our website, theoilbalance.com, you can sign up to get on our distribution list, and it'll give you even more information, a more detailed chart pack and statements about what's going on. So again, go to theoilbalance.com and request to get on our distribution list. So let's see what we have in the pack this week. So, like we were saying, the NYMEX had a nice move this week, up almost $4, I think $3.80 on the weekly chart. Nice move back higher. Again, we had been talking about the market being contained in this sort of lower band that we were worried about, and now it seems to be breaking out. So this next week coming up will be really pivotal on sort of what will happen next if we can hold at these sort of levels. From an inventory standpoint, I think we can, as I was telling you last week on last week's episode, which I can pin here for you to see real quick. I was telling you how bullish the Iranian stuff was, and that it was more important probably than what the OPEC information headlines were, because that OPEC stuff was already sort of priced in. They did what was expected. So the new stuff is what the market was trying to digest and trying to price, and the result was to move the market higher by almost $4. One really interesting thing, though, is if you look at it from this sort of the top of the hill over here, we took the sort of the top of this down week, and then from the lowest week we had here recently, the lowest part of the body here, you do a Fibonacci on that, and we're actually really close to where we ended the week this week. So the 38.2 retracement was 64.69. We came very close to that here this week, pretty close to settling at that point. The full Fibonacci retracement, if you're familiar with that, would be 61.8 retracement, which would put us at $69.60. So obviously up here, closer to 70 and above our $66 band here, which we have as sort of our next resistance line. If we get up there, of course, we have to break through this sloping resistance line too as well. So those will become some issues. I think we can get up there. We'll see. If the market has the oomph to pull through it. The cash markets, the physical oil markets are certainly feeling tight, especially in the North Sea and the dated markets. Those are definitely feeling tighter. So we'll see if the market can continue to sort of push and grind back higher. It gets the U.S. shale guys out of sort of the situation they were in. If we were to get back to $70, you'd probably start to see them ramping up their programs again. But, like the guys at Diamondback said, they're lifting their foot off the gas pedal. They're just going to take a breath and see sort of where the market leads. Well, we got a nice $4 rally for them to think about here. So let's continue on, though. In the weekly numbers this week, we got some really poor demand numbers. So one caveat is you can see this week's gasoline number is pretty bad. The previous week was actually really good, and that was kind of leading into Memorial Day weekend. And that's not unusual going into a weekend that you see the domestic demand number really pop up. And what's happening is they're trying to supply the gas stations in time for that holiday. And so what the weekly EIA numbers really represent is how much oil is in primary tankage. And when you start taking it out of primary tankage and getting it through the rack process on the truck and on the way to the retail level, then it's sort of not being captured anymore by that weekly data. So again, they're trying to front load. I don't think there's anything nefarious going on. You're just trying to make sure there's enough gasoline available for these big holiday weekends so that nobody runs out of gas. That's probably a good thing. But it makes it appear like there's a lot more demand than there is. And so if that doesn't come true, if there isn't a ton of demand, Then the following week, you get something like what we had here, where the implied demand number just drops off a cliff. The other thing, just let me really quickly point out too, is that these are implied numbers, as I put on the title here. In other words, they're on the weekly numbers from the EIA, they're just looking at the change in inventory and the change in supply. And then from that, you can derive what disappearance or demand had to be. So if one of those other two inputs is not correct because there was a holiday weekend involved or somebody didn't get something reported in time or something like that, it would throw off the data a little bit. And so next week's numbers on Wednesday, the demand numbers were going to be looked at very closely to see what happens, to see if especially gasoline bounces back up. But this week's demand number for gasoline should definitely raise some eyebrows. Distillate as well, although it is, I mean, it's not unusual to get a downtick for whatever reason this time of year, and then should sort of start to stabilize a little bit as we go through the rest of the summer. Jet demand still on the high end of the 5-year range, and then this is just a compilation of the three. But because gasoline is such a big component to the domestic demand calculation, it obviously drives this big drop lower. But what does that mean? Where does that lead to? So if we look at the NYMEX related inventory, so in other words, if you were trading NYMEX futures, these are the various delivery points for the big contracts that you could trade on the oil side anyway. So crude oil, you're trading at Cushing, Oklahoma. Those are still on the very bottom of the 5-year range right here. Pad 1B gasoline did move inventories back up to sort of year ago type levels. Last week's number was very low. On distillates, Pad 1B distillate, so again, Pad 1B is basically New York Harbor. Still kind of flat. Last year at this time, we were starting to grow inventories. This year, just kind of continuing this flat trajectory. So that's maybe getting a little bit worse week on week, where we're not building like we did this time last year. At least we're still in the 5-year range, but we're at the very bottom of it. And then propane really took off this week. And again, maybe there's something fishy going on with those numbers. We'll see on next week's numbers. But we just got a huge pop in propane, at least in Pad 3 this week, to push us finally back above year ago type levels. So one thing, if you look at if we go back here and just look real quick at gasoline in New York Harbor, remember, is pretty close to year ago levels and not, it's pretty far from the bottom of the 5-year range. Whereas distillate in New York Harbor, we're very close to the 5-year range and we're getting further apart from year ago type levels. So those things sort of taken together are bullish, and the futures are giving us an indication of that. So one spread that's sort of people like to trade, it's also called the Widowmaker trade because it just can snap all over the place. But one popular trade, one thing that people tend to track quite a bit is the RBOB to heating oil spread. So we're looking at RBOB minus heating oils. That's how you would read that. Typically, well, most of us would assume in the summertime, gasoline would be at a premium to distillates because that's sort of max driving season. If you go in and get on our distribution list and you subscribe to our bigger chart pack, you'll see that maybe that's not always the case. But at any rate, for this week and for the data we have, we can see that June, the blue line here, M is June in future speak, did actually go out at gasoline over. However, over the past few days, now that July is the front month, beginning with the June and the calendar month of June, we can see that that's quickly dropped off, and distillate is now at a premium, and that's true. August had always been a distillate premium, at least for most of May, and then September we just picked up on our chart, and September is at a pretty decent discount to gasoline. Gasoline's at a pretty decent discount to distillates. That's not as unusual because you start to start thinking about fall and winter time as the summer comes to a close, especially in the farther northern climates. The other interesting way to look at this is the open interest. So again, the every buy has a sell on the futures market. So you can track just the new buys or the buys that are open, and that's called your open interest. what I'm trying to point out here, the blue lines, both the solid and the dashed, are for the June contracts. The dashed is for heating oil, and the solid is for gasoline. In the orangey color is for the July contract. So July RBOB in the solid, again, so gasoline and solid, dashed is distillate. What I'm trying to point out here is at about the same time, or around the fifth, sixth day of the month, we had fairly high open interest in both contracts. They were fairly close to each other, not too far of a spread. You sort of fast forward to that same time now in June, at the very beginning of the month, and you're looking at a much larger spread in open interest. So, in other words, there's a lot more open interest in the gasoline contract than there is in the distillate. If all this open interest was to get out because they're not happy with the position, that could push prices lower and even whack this heat to gas spread even more than it already has been. So keep a close eye on that spread. And again, if it gets wide enough, it will encourage refiners to change their yields. If it gets wide enough for long enough, it will encourage them to change their yields. So that's definitely something to keep an eye on. In terms of the arbs, though, it's kind of a different situation going on in the Midwest. So again, group is the pricing region between Oklahoma City and Tulsa, so the very southern edge of the Midwest, or the very southern edge of Pad 2. Distillate stocks had been really low. They did have a good bounce back this week on the numbers, back to sort of the very bottom of the 5-year range. Gasoline stocks are much closer to year ago type levels. So in that sense, similar to what we're seeing in Pad 1, at least Pad 1B, where distillates at or near the very bottom of the 5-year range, gasoline's closer to the center and closer to year ago type levels. What's really interesting, though, is if you look at these arbs, so again, looking at like the Magellan pipeline system going from Houston up to Dallas, you take sort of a hook over and you end up going up into Oklahoma City. Those arbs were open for a long time on the diesel side of things, or the distillate side of things. As you can see here in the May contract, this time in blue. The June contract, though, as we sort of got towards the end of the month, said, no, we're not going to keep this arb open, even though stocks are really low. So again, I think this is something else worth tracking, worth keeping an eye on. It would seem, you would need to get inventories back up because you will have harvest season going on here in a couple months. So you want to try to pad inventories up in Pad 2 a little bit in preparation for that. So I wonder if this doesn't open up and put more strain on Pad 3, on those inventories down there, where they do seem to be increasing a little bit more in Pad 3. We're kind of back to where we started the year on those inventories. On the gasoline side of things, CBOB is a gasoline blend stock, sort of a conventional blend stock that needs ethanol or something, or some other oxygen in it, to bring it up to 87 octane and that you could sell at the pump. In any case, it's we're comparing Group CBOB against Gulf Coast CBOB, so the same grade pretty much. Those arbs are all open. As you can see, the May went out open at the end of the month here. Green is for the June contract, and it sort of gets lost here a little bit, but it is still positive. It's still above the tariff level. Here, July and August are open. August is right on the very edge of being open. And then September is finally closed. September, kind of at the end of May, decided, no, we're closing this arb. This is too crazy. So this is a little bit interesting. This is something worth keeping an eye on. So it certainly seems like the group of the Midwest is definitely calling for gasoline and not calling for diesel. But if you look at the charts, you would think that would be flipped around, where they would be calling for diesel. So again, keep that in mind. That's an interesting situation going on there. Another thing you can see in this stack of prices that we've had, normally I try to organize them by price. It'll be sort of tough trying to move everything around all the time when you get a lot of volatility in these things. But hopefully you can see here that heating oil futures, of all the things we have listed, is the most expensive on the board right now. RBOB futures coming in second. Gulf Coast Diesel, Gulf Coast ULSD, or Group ULSD, which we were just talking about, coming in third, and then Gulf Coast coming in fourth. So a little bit of movement in those from what we've seen here recently, and we can probably expect more volatility on this chart and all the others that we just looked at as things move on. Again, I think a lot of that had to do with that gasoline demand number. If that demand number should pop back and inventories drop down, maybe you get a little bit of a flip back to premium gasoline for a little while, but definitely interesting moves this week. On the LA shipping stats, getting some movement. So for week 23, we were looking for 96,000 TEU. That got bumped up to 100,000, 101,000 TEU with the new information. For week 24, that was looking really big at 106. That's now been sort of downgraded to 90. But the new information we have here for the following week is 114,000. So for week 24, so a pretty decent number. Again, we'll see the numbers that are furthest out in time probably have the biggest error factor in them and get can swing around somewhat as new information comes in. So again, a little bit of grain of salt with this number here, just like we did with this number last week. And then last thing, retail prices are coming down slightly week on week, not huge moves, but both came down a little bit week on week. Again, with the $4 rally, $3.80 rally in crude oil, I would imagine that the retail prices will probably be up week on week when those numbers come out on Tuesday. Go ahead and update them at that time. So I would imagine it would pop back up on the week, but we'll see. From driving around, at least in my part of the world here in Texas, it doesn't seem too, I'm not seeing sticker shock or anything like that at the pump. So maybe keep your eyes peeled out for that. And let me know in the comments if you guys are seeing some crazy pricing going on. That would be interesting, and I'll try to track that down for you and figure out what's going on there. So that's really all I have this week. Here's a quick summary of what's going on if you want to kind of go back through the video a little bit and rewatch something. But again, please visit us at theoilbalance.com. Sign up to get on our distribution list. We'll put you on a free trial, but then obviously want to bring you on as a subscribing customer at some point in time. But so stay frosty. Should be an interesting week again this week. We'll see if the oil markets can hang in there. Again, they're definitely feeling tight. If we can actually pull that through and, maybe we can get back to that $70 point where U.S. shale starts cranking up again. So we'll see. Anyway, talk to you next week. Bye.